Please welcome Brian Corbett, President and CEO of MFA.
Good morning. I'm Brian Corbett, President and CEO of MFA. We are a global trade association that represents the alternative asset management industry, and we are thrilled to have all of you here with us this morning for an important conversation on U.S. capital markets. While we've all been watching the recent market volatility, we are bringing policymakers together today for a forward-looking conversation. How do we implement regulatory policies that strengthen U.S. capital markets over the long term? Looking beyond days and weeks, the primacy of America's capital markets depends on vibrant public and private markets that allocate capital to companies at all stages of their journey and provide the fuel for economic growth. Unfortunately, there is a regulatory overhang that has taken its toll. Since 1996, there are 30% fewer public companies. We've seen 90% fewer IPOs. And today, 70% of the private market unicorns have been unable to raise capital in the last 3 years. Policymakers on both sides of the aisle agree that we need to take action to reverse this trend and to promote market growth. To reinvigorate our markets, MFA supports policies that, first, embrace alternative asset managers as an important market driver. Reduce the regulatory overhang that causes inefficiencies. Create an environment that attracts companies to going public. Embrace pro-growth tax policies. And lastly, expand investor access to alternatives. Now is the time for policymakers to take action, and we are prepared to work with them as we move ahead. We have a terrific group of speakers with us here this morning, but before beginning, I want to thank our partner Whitehall for working with us to put this event together. We are really fortunate to have with us this morning Deputy Secretary Michael Falkender. Already today, futures in the markets are up about 700 points in anticipation of this discussion. So we are really happy for what we're going to hear, but please join me in welcoming to the stage Deputy Secretary. Thank you. So I alluded to it, but certainly over the past few days, we've all been observing a lot of the ups and downs in the market, and just would like to hear your current perspective on how you're thinking about market activity.
Sure. So, I think the market's up today probably because Secretary Bessent preceded me coming to this event on CNBC this morning. But, the President and the Secretary have been very clear that part of reorienting the economy, part of reprivatizing the economy is really focused on making sure that we have a durable manufacturing base here in the United States. It's not just important for our economic security, but for our national security. And so making sure that we put in place a combination of policies that facilitate private sector investment, private sector fundraising, private sector growth, and innovative activities taking place here in the United States is at the core of our economic agenda. And so the tariffs are just but one part of a broad economic policy agenda that the administration has that touches upon many of the things that you mentioned in your opening remarks. So at the center of it really is energy dominance, deregulation, reducing excessive federal spending, and the effect of excessive government on the private economy, extending pro-growth tax reform, making sure that we have open and accessible capital markets, both in financial markets and in financial institutions, strong dollar policy, and addressing some of the persistent trade imbalances that have existed for decades. And so there is a full speed ahead effort on the part of the administration. I don't think anybody is under the impression that the president spent the last 4 years doing nothing. He's given a lot of thought and put together a team that's been ready to go from day one to implement this agenda. And so I'm happy to go into the details on a lot of those things.
We've been watching, as have a lot of market participants, just the plumbing and the infrastructure of the markets as we've seen the ups and downs, and certainly something you and the Secretary have been watching closely. But with all of the activity, the underlying plumbing of the system seems very strong.
That's right. As you can imagine, Treasury watches very closely to make sure that there aren't any disruptions, that liquidity is available, that capital continues to flow. My memory serves, I think we set a record in the last couple of days on Treasury market activity, and the plumbing is working just fine. We're always going to be watchful that there aren't impediments to liquidity coming into markets when there is volatility. But from what we have seen so far, despite the movements in stock prices and in other markets, that liquidity continues to flow and that we're not seeing impediments that have created any concerns yet.
I want to come back to the deregulatory point, but we're also all watching the debate that's playing out around tax reform. The tax extension's coming. Congress is working through the reconciliation process. As you and your colleagues approach the tax reform, there's a balance of how do you promote long-term incentives to invest in America with raising the revenue that you need. How do you think about that balance? What are some of the considerations on both sides?
Right. So let's start with just looking at the historical data for the last 60 years or so. Revenues to the federal government have averaged about 17% of GDP. Even following the Tax Cuts and Jobs Act in 2022, we saw that revenues hit 19% of GDP. So when we have strong economic conditions, when you have a stock market that's rising, we can, under the current tax code, bring in significant amounts of revenue even under the current tax structure. The challenge, of course, that we have in Washington is that spending has blown out. For the 50 years prior to the pandemic, federal spending averaged 20% of GDP. So, if you run a 3% debt to GDP or deficit to GDP ratio and you have 4% nominal growth, you're going to be fine, right? That'll allow you to easily maintain a moderate debt to GDP ratio. The problem is that currently we're running spending at around 23 to 24% of GDP. Congressional Budget Office and forecast that that's going to continue as far as the eye can see. 7% of GDP deficits, again, even in a 5% nominal GDP environment, is unsustainable, right? So the challenge that we have is that spending is out of control. That's why the president asked Elon Musk to come in from the very beginning and identify efficiencies and improvements that we can identify in federal spending. Congress, as part of the discussions over the reconciliation package, are looking across the spectrum for where we can find savings. So really the way that we're going to bring the fiscal situation back to a long-term sustainable place is that we couple economic growth. So if we can get nominal GDP growing faster and simultaneously bring down deficit to GDP ratios by going after wasteful spending and the massive growth in spending that's taken place, we can get ourselves to a long-term sustainable place.
As you think about the spending priorities, what are some of the incentives for investment that are part of the discussions?
Right. So I think you saw when we negotiated the Tax Cuts and Jobs Act initially, it really is about recognizing the incentives for private sector activity. So part of that is in the tax space, part of that is in the regulatory space. One of the things that surprised me over the last couple of years is hearing people from your industry say that it's actually sometimes easier to raise capital and innovate in Europe and in Asia than it is in the United States. In my lifetime, in my adult lifetime, those are words that I had never heard before, but we saw just the regulatory blanket that Gary Gensler and the SEC put in place, and that really created some challenges. If at the same time you have policymakers talking about massive increases in taxes, whether that be corporate taxes, whether that be capital gains taxes, whether that be taking away accelerated depreciation schedules, all of those things are going to make the United States uncompetitive. I remind people all the time, in 1986, the last time we did big tax reform prior to the Tax Cuts and Jobs Act, and we brought the corporate rate in this country down to 35%, that was a below median OECD corporate tax rate. So if you look at all of the developed countries in the world back in the mid 80s, more than half of them were above 35%. Between 1986 and 2016, we went from a below median OECD corporate income tax rate to the highest. Not because we raised ours. We didn't touch ours from 86 to 16. It's because everybody else saw that a high rate is uncompetitive and they needed to bring their rate down. And so that's why we brought the rate from 35 down to 21. That put us back in the middle of the OECD. We are not a tax haven at 21%. We are right in the middle of the pack, which is what allows our workers, our regulatory environment, our customers, our economic strength to then cover any other competitive differences. But the idea that you would take it back to 28 or even 25, again, that tends to make us less competitive. Mm-hmm. And the whole point is, if you're going to realize economic growth, if you are going to recognize national security, if you are going to be the international standard setter, be it in capital markets, be it in cryptocurrency, be it in energy, if you are going to be the standard setter for the world, that activity has to primarily or largely be happening in the United States. And so if we lose the competitiveness of our capital markets, if we lose our industrial base, if we tell innovators that if you want to do AI or crypto, go abroad because we put restrictions on the ability for US companies to innovate in those things, then don't expect us to be the standard setters in international bodies, right? The last thing we want is the Chinese setting the ground rules on artificial intelligence or on next generation payment systems. And that's where we're headed under the Gary Gensler, Joe Biden type of approach. And that's exactly what we have rejected in the Trump administration. It really is about providing a competitive marketplace for innovators and idea creators to explore, put private capital to work, figure out the way to best serve the American people and the global people. But let's make sure that activity takes place here so that the American people benefit from those innovations, and so that when it comes time to set standards and to determine what the rules of the road are, that the United States has the primary seat at the table.
So you referenced Gary Gensler a couple times. We as an industry very familiar. He proposed 22 plus rules targeting us. We had to sue him 3 times for the first time in our history. But as you come into the seat, you were in the first Trump administration of Treasury. You come back. Deregulation is an important part of unleashing American innovativeness, competitiveness. How are you thinking broadly about the deregulation agenda and how to coordinate that across all the different agencies?
Right. So there's a lot. As you said, Gary Gensler implemented a number of rules. Also, if you look at the financial institution regulators, they also clamped down on a lot of things. So we have a very busy agenda ahead of us. You've got to, of course, start with removing some of the more onerous rules. Congress is doing some of that through the Congressional Review Act, but think about the climate rule, the SEC climate rule that was put in place. That rule all by itself, according to Gensler's own numbers, doubles the cost of compliance, right? Without, as Jay Clayton said, providing a single bit of relevant information to investors. So this notion that that the Biden administration had, that we're going to essentially turn every financial regulator into an environment regulator, is just an approach that we reject. On the bank regulator side, okay, so they were again trying to implement various climate rules and other parts of their agenda through the regulation of what they called reputation risk. Our view on it is, once you regulate capital, once you regulate assets, once you are meeting your requirements on liquidity, there's nothing left for reputation risk to capture other than a political agenda. Therefore, it's out, right? When we think about the amount of liquidity the system needs in times of shock, it seems striking to me that exactly when you need financial institutions to come into markets and provide liquidity is exactly when the capital requirements and the liquidity requirements are actually binding them and keeping them from engaging in providing that very liquidity you need. If we over-regulate capital markets, if we over-regulate financial institutions, all you're going to do is move those activities into the shadow sector, which does not make things better for investors. It does not make things better for companies. It does not make things better for policymakers, because in the regulated markets, whether it be financial markets or financial institutions, we know how that plumbing works. We know what to monitor. If things move out of that sector and into the shadow sector and we have some kind of shock to the system, we don't have the early warning lights. We don't know where that money is. We don't know where the risk is accumulating. And so there has to be a limit on how far you can take the regulatory blanket without pushing everything into an unobserved shadow market and therefore it being more of a Wild West. You do not improve investor information. You do not improve the controls and the kind of taking care of that investors aren't being scammed. If you move everything out of the regulated sector, you actually impede the ability of making sure that investors get the treatment that they need.
Yeah. One of the trends we've seen over the past few years is, as I talked about the opening, sort of a decline in the number of public companies, but we've also seen a really important and beneficial growth in private markets. The ability of other sources of capital, particularly private credit and other equity sources to companies. So as you think about the deregulatory approach and also policies that continue to promote more capital for companies, whether it's public or private, how are you and your colleagues in the early stages thinking about supporting that continued growth of private markets?
Right. So overall, I'm not terribly concerned about private sources coming in. I view this as very much a continuation of what we saw post passage of Sarbanes-Oxley. For those of you that are unfamiliar with my background, I'm a finance professor by training. And so one of the things that we know is, firms make a trade-off when they are deciding to be a private company or be a public company. And if the regulatory compliance costs of being public are too great and they can substitute to private sources of capital in order to fund their growth, they're going to do it. So I don't per se, so as long as private equity is coming in and providing capital that facilitates growth, that's all right. If that is not accessible, if there are companies that are finding barriers to raising capital, then that's where policymakers need to come in and say, can't we lighten this burden? Are we actually achieving our objectives? Again, are we providing information that's relevant to investors such that price discovery can take place, such that they can have the information necessary to know what investments that they think are going to be valuable in the future versus those that they don't think have market opportunities? If we're providing that kind of information, fine. But if the information is being done for check-the-box compliance purposes or in search of a political agenda, those are the types of things that we want to roll back, because every dollar spent on compliance is a dollar that gets passed along either in the form of higher prices, lower wages, or lower rates of return that fund retirement. And so we need to get those deadweight losses out of compliance so that we're focused on the things that are actually going to facilitate capital formation, investment opportunities, and ultimately improvements in standards of living for every American.
Yeah, certainly you mentioned Dodd-Frank as post that Dodd-Frank Act, other sources of capital, particularly private funds, have stepped in to provide more and more credit and other types of financing. And as we move to close here, one of the growing topics of importance in Washington is around who can access some of these investment funds. And I think some of the speakers we're going to hear after you are going to focus on this idea of democratizing access to private markets. So we want more people to have access to private markets, but we want to do it in a way that continues to promote investor protection. So that'll be an important issue. And I imagine you're at the early stages of starting to think about some of those issues as part of the agenda.
I have thought about them a little bit. It's, the challenge with using simply an earnings test, right? So I think about myself. I got my PhD in finance at 27, but I, was coming out with hardly anything, and I'm not a qualified investor. Right? It seems a little surprising. I think I kind of understood at that time the risk-return trade-off that I was making. And the idea, as you said, that we're going to take people who understand the risk-reward trade-off, and because of their current wealth level, we are going to keep them from accessing investments they fully understand, seems in complete conflict with notions of individual liberty and freedom that are the hallmark of our country. So yes, there is a role for regulators to play some form of a paternal role to make sure that people don't get ahead of their skis and in over their heads, and that we protect the widows and orphans. But we can't, in the process of doing that, keep Americans away from sources of wealth creation and have them only available to the wealthy, right? So to the extent that we are going to fulfill our notions of mobility, economic mobility in our society, it means that we do, as you said, need to democratize access to different capital assets.
Well, Deputy Secretary, I know it's a busy day, a lot going on. Thank you for taking the time to join us here this morning.
Great to be with you.
Thank you very much. Appreciate it. You want me to...
Hey, everybody. Good morning. Jillian, good morning. I'm Steve Clemens. I'm editor-at-large of National Interest, and we're also Whitehall is partners with today's event, so I want to thank you all for being here. With me, we have Jillian Flores, who's the Chief of Advocacy for MFA. This is an MFA morning, and wow, we expected maybe a higher dropout rate than this, but you must love MFA. So, and I just want to do one quick shout out. There are many ambassadors and important people in this room, but Georgette Mosbacher, our former ambassador, stand up because it's great to have you here. She doesn't show up for many people at 7:30. And Paul DeBar, stand up. Paul is our Deputy Secretary nominee for the Department of Commerce, possibly about to get confirmed, but we're going to see. But Paul, I know you've got a busy morning. Thank you both for being here and everyone else. Jillian, great to see you. Look, today we're talking about capital markets. What are the building blocks of a healthy economy, investment? How did private capital fit into much of the anticipation that this economy has to move forward? And we have three members of Congress joining us, and we're going to have them in succession from both sides of the aisle, and Jillian and I are going to grill them. Welcome to the stage, a member of the Financial Services Subcommittee on Capital Markets, a member of the House from Indiana, Marlin Stutzman. Marlin, please join us. Thank you so much.
Good morning. All right. Well, the grilling will begin. I think it's such a wonderful pivot opportunity to turn from the Deputy Secretary's remarks and really talk to members of Congress who are in roles to help accomplish some of this change that we're talking about here. You are about 3 months in the seat, but this is not your first time. You're not new to Washington. What drew you back to Washington?
Great question, and I'm especially asking that today. No. It's a great place to serve. I'm an entrepreneur, I'm a businessman, and I like to help fix problems. And being in the private sector for the last 8 years has given me a refresher on how difficult the private sector can be. And our family is primarily in agriculture and manufacturing, two very difficult industries at times, but also two very rewarding industries at times. And both of them have been great for our family. I obviously served before. I was in the State House in Indiana soon after 9/11. That was what really prompted me to run for office with a young family. And then served until 2016, left after a failed Senate run, and felt that I still had more to offer. And so when the seat became available this last cycle, I chose to run again. And I'm glad to be here. It's a very momentous time in our history.
Marlon, we have a very diverse audience here. We have, as I mentioned, Paul DeBar moments, from science. We have people in the capital markets industry, people that are, regulators, people who are in the Treasury, a lot of different places. And what I want to ask you is about the ecosystem that we're in. And what do you consider to be the most important pro-growth building blocks to get in place? And I assume when you tell us that, it's going to be a criticism of what wasn't there. So what's in the way of healthier capital markets?
Well, I'll speak a little bit from my experience. So in Northeast Indiana, we're one of the heaviest manufacturing spaces in the United States. We have orthopedic industry. We have, of course, the automobile industry, steel industry, and there's so many other things that are built in northern Indiana. The 2nd Congressional District and the 3rd District are two of the heaviest manufacturing. And then we're surrounded by, of course, agriculture. And where we're located, we're right under the Great Lakes, and so we're kind of a bridge from the east, northeast to the northwest, and a lot of travel goes through there. So we also have a lot of logistics. But for growth, it's always capital formation. Especially when you're doing a startup, maybe you have a lot of expertise coming out of a different space, but you still have to go sell the idea. And I've done several companies, and sometimes they start with a 3-ring binder. Sometimes they start with a nice PowerPoint presentation. Obviously, it depends on your investor. And that's one of the things too, the Midwest investor is very different than the East Coast investor or this, Texas investor or California investor. But I still think it comes back down to confidence in the direction that you're going. And but I would say capital formation was always the more difficult one. You can always find legal help. You can always find the other pieces of it, but finding capital is really challenging, especially for those of us in the Midwest.
I love the way you talk about it as not a one-size-fits-all need. There are different types of investors, different geographies. The committee, the House Financial Services Committee, is undertaking an exercise right now where it's collecting legislative proposals on how to improve capital formation. And I know you've been playing a leading role with a few specific bills that seek to accomplish that. Could you talk a little bit about where you think the committee's headed in terms of its process and ability to get some stuff done, and where are you most focused?
I'm most focused on the community bank regulatory framework because, again, I don't think that even in our banking system, one size fits all as well. We don't have, the largest bank headquartered in Indiana is Old National Bank out of Evansville. A great bank. There's a lot of great banks in Indiana, but a lot of them fit that smaller, mid-size market space. And so they have their challenges. One particular investment that we made, it was February of 2020. It was in the entertainment and hospitality space. February 2020 is when we made the purchase, and it was the worst decision of my life. But you know what? It was a great learning experience, and so we had to really work with our not only investors, or eventually we had to find investors, but we were working with the banks at the time, and the banks were looking for an exit. And so we worked through that. But I think from their size and the regulatory piece that they have on themselves, they were really trying to make sure that their portfolio was as clean as possible, especially considering the circumstances over the last several years. So I think that, community banks especially maybe have a little outsized proportion of regulatory framework on them. But again, when something goes south, then it's like, so there has to be really a good balance of that. But I think supporting those mid-sized banks in our communities is really an important piece. And then also investors, kind of opening up that piece for people to invest locally. I think that's a smart way to go. Invest in what you know, especially in the Midwest. Ag and manufacturing are the pieces that we know. And there's people that are interested, but they don't necessarily always know how or do they qualify. And so there's some of those pieces that I'm focused on.
And you have a bill that seeks to accomplish this, changing the accredited investor standard. We just heard the Deputy Secretary talk about this as well, really making sure that's fit for purpose and not kind of artificially limiting to investors that could be taking advantage of private market growth. Yes,
no, exactly. And I come from a very conservative nature in agriculture because you can't control a lot of things in the marketplace with ag, whether it's commodity prices or input costs or then the weather. So you have to really be careful and conservative. And I think that's a lot of the tendency of the Midwest is to be more that. But once there's opportunities, we always looked outside as well, even though I want to try to really generate growth and wealth in Indiana and the Midwest. But you can't just sit there all the time. You have to look elsewhere and really balance your portfolio. But part of it's an education piece, but it's also once the parameters are set, can more people participate? And I think that's a good way to go. Crowdfunding is another option, but I think most people like to sit down across the table from each other. That's what I like to do, and just look each other in the eye and have that conversation. This is what we want to build. This is where we want to go.
Like right here in a minute.
Is that right? Yeah.
There we go. We got two Democratic colleagues of yours coming.
We could make the deal right here.
Yeah. Let me just ask you in our quick minute. A lot of this discussion about how to get regulation right. I'm going to be honest about the media. I've got a lot of friends in the media here today, and I don't blame them. But it's treated in a binary way of either too much or too little regulation.
Right.
I'm really interested, and you've got Democratic colleagues here. What does smarter regulation look like? What kind of regulation in the capital markets area do you support as opposed to this black and white version of less or more?
Well, that's a tough question. I think I would kind of take it
like
back
a minute and 20.
Yeah, well, I guess I'll give you an example. Farmland. Farmland actually is great of an investment, maybe even better than gold. Because if you look at the growth of farmland, plus you throw on top of it the value you build out of a crop, you can actually almost hit 7% average compared to 5% growth in gold. So farmland there's a lot of equity out there. Can we leverage that equity? That's what we've done, is leveraged equity in farmland and other assets. So I think those are the pieces that we've found, and I've kind of done it more the old-fashioned way and just figured it out. But if I can share that sort of concept with people and using that, but there's always well, I don't want to lose it, because they've worked their whole lives for something and they don't want to lose that. But there's a lot of value in the Midwest that I think is underutilized. And if there's ways to capitalize on that, I think that would be a smart way to go.
Jillian, you want to squeeze in that squeaker on the Senate?
Okay, yeah, let's make this hard on you, Congressman.
No. Hey, the markets are up, so let's not mess anything up.
The Senate budget is something that the House could take up tomorrow.
Yes.
To be determined what that vote looks like. Interested in your views, how you're thinking about your own vote and that overall process.
You can be binary, yes or no in this.
Yeah, right. I don't want to, see, that there's an old saying that my Democrat colleagues that are going to be coming over, they're not the problem. The Senate is the problem. Always. And
we probably have some Senate staffers here in the room with us today.
You take that message back. I don't care. No, because I was a senator in the State House one time. But no, I think that it's both of us are going to work together, and we're going to find a pathway forward. We have to. This market fluctuation, or the volatility over the last couple of weeks, or a couple of days, I should say, that can be managed. It's the debt crash crisis that I fear the most, and we've got to balance a budget. Somehow we got to lower our debt and deficits. Those are really important.
Marlene Stutzman, thank you so much. Good luck with all the decisions you have. Thanks for joining us this morning. Yeah, appreciate it. We're going to go out this way right here. Please welcome to stage from the great state of Illinois, a Democratic congressman, also on the House Financial Service Committee, Bill Foster, a good friend. Thank you, and Jillian,
Congressman,
as well.
great to see you.
Congressman, thank you. One of the things we're talking about capital markets, but I want to tell our audience, I've had the pleasure of interviewing Bill several times. I want to remind people he also is a businessman. He happens, any movie you go to, any of the light, how much lighting, movie lights are you responsible for?
Well, we're about 50% of all the theater stage lighting in the U.S. Probably close to 60%. But when I was 19, I started this company with my little brother that now manufactures about 60% of the theater lighting. We're 90% of the lights on Broadway, 50% of touring rock and roll. So I did that when I was 19. We started in our basement with $500 with my parents, and the company just completed its ESOP, and it's now 100% employee owned, about 1,500 employees up in Mazomanie and Middleton, Wisconsin, if you know where that is. And
you rarely hear Democratic congressmen with this sort of experience, so I just want to highlight it. But just to jump in, Jillian has got a line of questions. In your area, with somebody starting out in your industry, or even as you were, how important are the capital markets industry?
Well, it wasn't for us.
Okay.
Our initial capitalization was $500 to my parents. No.
Jillian.
Okay, well, I just hope these lights are
They are in
Foster
fact
lights.
not.
Okay.
They are in fact not.
All right.
It's all right.
Moving on.
So you're in the
well.
40% that's
Okay.
not with it yet.
So speaking of capital formation, capital markets, you've had your own experience, but also I happen to know you as such a thoughtful member of the Financial Services Committee who's really dedicated a lot of brain power over the years into thinking about these issues. Where are there opportunities for bipartisanship? We just heard from Congressman Stutzman. I know you've been following along the priorities of Chairman Hill and Chairwoman Wagner. Where do you think this goes, this Congress?
Well, I think the strongest area is artificial intelligence, which is going to turn everything upside down. The nature of market participants is going to just change radically. From the individual investor point of view, you're not going to be interacting with the investor. You're going to be interacting with the investor's AI agent. That's going to have huge implications for the bank. I'm the lead dem on the banking subcommittee. And so, for example, if you look at what would have happened with Silicon Valley, if everyone was interacting with their bank through their AI agent, the first thing would happen is the money would have run much more rapidly. And so one of the things we have to do that's recognized on a bipartisan basis, we have to do something about internet-driven bank runs, which are now going to proceed at the rate of AI, not the rate of internet rumors. So that's a big worry. The other thing is a lot of banks were in trouble when Silicon Valley went under. They got into made a bad bet on interest rates. And so those banks were saved because they had sticky customers that were happy to be in zero interest deposits. As the interest rates lifted off, they captured the interest rate spread, and that allowed them to recapitalize and get out of trouble. That would not have happened if all of their customers had an AI that woke up every morning and shopped around for the best interest rate. And so that's one of the many destabilizing influences that are going to come into the markets and the banking system just because AIs are so much more responsive.
You know, I'm not saying this would be nice to MFA, but I like one of the major goals of MFA, which is to look at strategies to democratize the benefits of growth of MFA, if I'm framing that right, which is really kind of broadening out, you know, the stakeholders in this industry. What do you think the role of Congress ought to be in trying to achieve that goal?
Well, we have to have regulation that respects the sophistication of the investor. So, you know, where we've spent, you know, a big part of all the 15 years I've been on Financial Services Committee talking about what that threshold should be. And again, AI is going to change that. Everyone is going to have, when they're in any market, they will have the equivalent of really cagey uncle looking over their shoulder. So if you're buying a used car, your AI agent is going to go and look for best and final offers from all the nearby used car dealerships. Then when you choose your car and they try to steer you into a crappy overpriced loan, then you're going to say, okay, your AI will say thank you very much, but we've looked on the internet and there's a better deal. And so you're going to see, it'll change everything when you're interacting with the individual's AI agent. It means every person will be sophisticated, or at least have access to the advice much more sophisticated than anyone else.
You know, it's not lost on me that AI is artificial intelligence, but also accredited investor. So maybe these things coming together here, as you mentioned. Want to maybe turn back to your commentary about the banking system and shift to the market participants outside of the banking system who are fundamentally important to capital markets in particular, a lot of what we're talking about here today. You have been a longtime leader of legislation trying to improve FSOC's process in how it thinks about the role of non-banks and how it uses its tools to ensure financial stability. Are you bullish on that bill this year?
Oh, I have to have some consultations on that, but I don't want to predict. You know, it's very delicate having these sort of bipartisan negotiations. We'll, if we can make progress on that, we certainly will.
What's your basic take right now on this economic moment? We have a lot of people in this room that reflect not only the enthusiasm for the economy, but the anxiety. We just had the Deputy Secretary of the Treasury up here. And I'm going to be honest, this is my own editorial view. A lot of Democrats today sound like what Republicans used to. They become very anti-tariff, et cetera. And you have a lot of Republicans that have changed ship. But I guess the question I have for you is, you know, North Starism, when we're thinking today about healthy governance, healthy regulation, democratizing the markets, thinking about what gets in the way of growth, do we need a reset in some of the way in which we think about the economy?
Well, I think in terms of the consumer-facing regulation, AI is going to give us a chance to really have much lighter touch consumer, because you will have sophisticated participants. And that's something where the main issue is to make sure that the AI advisors' interests are aligned with the consumer. And that's that's sort of the future of this, the alignment problem. You don't want to have your AI doctor taking payments from pharma to steer you into crappy overpriced drugs. And in the same way, you don't want to have your AI advisor taking payments that you're not aware of. And these are going to be nearly free. The cost of having the best financial advice in the world will be near free. And it's going to, you know, change everything. It's going to squeeze the margins out of all consumer-facing operations, which is going to be very destabilizing. The whole business with robotics, you know, the current estimates are by the end of this decade, there are going to be 1 billion robots on Earth working 3 shifts a day for a full cost of maybe $5 an hour. Okay, and they'll be able to do a large amount of what humans do every day, working on assembly lines and things like that. And our economy isn't ready for this. And we have to, and our just sort of thought process isn't that. When AI and robotics drive the value of human labor, the market value of human labor to near zero, we're going to have to rethink a lot of things in society.
So you might spend more time thinking about AI than just about any other member of Congress. I think it's safe to assume. AI touches a lot of things, not only financial markets. How do you see the Financial Services Committee as a role player in terms of what the policies should be?
Well, one of the first things that we can do that will make a difference just throughout financial services is having a secure digital identity for all Americans. You know, everyone is on high alert because of this deepfake impersonation. Probably most of you have heard of the $25 million heist with a Zoom deepfake impersonation on Zoom at a financial firm. And so that is the first line of defense against that. Well, first off, everyone imagines, oh, we're going to have some magic software that's going to tell the difference between a deepfake and a real image, and that's a losing game, in my opinion. The next line of defense is to provide people with the ability to prove they are who they say they are, and not a deepfake impersonation. That happens with these secure digital ID, digital driver's licenses. A real ID compliant digital driver's license allows you to prove you are who you say you are in an online environment. And the EU is doing this. I think by the end of next year, the EU, every citizen of the EU is going to be able to do that. It turns out the government of Poland just came through my office, a big legislative thing, and Poland just kicked out, they had a Trumpy government, they kicked them out because people were pissed about inflation, which it tells you how random this whole business is. But but the only popular thing that this government of Poland did was establish a citizenship app that allowed people to prove they are who they say they are. Right. And that made there's a flowering ecosystem of fintechs and similar industries built on top of this rails of individual identification.
Well, America's former ambassador to Poland, Georgette Mosbacher, is right here, so she can help you with any problems
all
you
right.
have there.
Okay.
But Bill, listen, I just want to thank you. I don't know if we figured out how to identify your lighting from other lighting, but we know that the likelihood is it's your lighting. Anywhere we made, I want to thank Congressman Bill Foster for sharing his thoughts with us this morning. Thank you so much for joining us. We look forward to what you're doing in the AI front. Thank you very much. Thank you,
Congressman.
Now, welcome to the stage a member of not only the House Financial Services Committee, but also the Joint Economic Committee, which happens to be one of my favorite committees in Congress. So again, to Sean Casten, thank you so much. Also from Illinois, meet Jillian. Sean, great to have you. Let me just start out real quick, and I know our time is short, but Joint Economic Committee used to be this place, and I worked there in the 1990s, where we would put out ideological stuff, you know, Hamilton and Friedrich List and, you know, Adam Smith. We would kind of remind people. And then I guess I was on, I can't remember because I've been both Republican and Democrat, but I guess then the other side would come in who would get control of the committee and send it. So basically I'm wondering, you know, just to start this out, would love to go this, as we think about markets and regulation, you've heard a number of your colleagues up here and also the Deputy Secretary of the Treasury, from a joint economic perspective, which gets to first principles of how to run an economy, what's our North Star from your point of view?
So we have not yet had a Joint Economic Committee meeting. Our first one is this week.
Oh.
So I'm purely speculating. I'm honored to joining it. I think I got picked for it because every time I had some weird question and I was unable to get Jay Powell on the phone as quickly as I would have liked, I'd call Don Beyer and he'd like, we can do a JAC analysis and that. So I've really appreciated what they've done, but I'm looking forward to seeing what they do. I think to your point, like.
So what you're saying is you're green and you don't know yet.
Yes, okay. Yes. But I do think the hope, and what I've always enjoyed about the JAC as a member is there are objective truths about the economy. There's spin on the corners, there's agenda, but you'd like to know objectively, I think of, a couple of years ago when I was saying, I want to understand if the U.S. doesn't have a policy in place that's going to get COVID under control quickly and China does, what does that do for long-term balance of payments? Are we going to become indebted to China? The JAC is a place where you can ask questions like that. You just want to understand what are the levers here so that we've all got our political agendas, but let's get the facts before we decide what to do with the facts, right?
Well, I suspect your first meeting will be super quiet and boring because there's not much going on. Turning now to capital formation and your role on the Financial Services Committee. The exercise that the committee is undertaking, looking at a lot of ways to enhance public markets and also private markets, I would imagine maybe hits especially close to home for someone like you who knows firsthand what it takes to go out and need to raise money for your business. How do you think about these barriers, obstacles, and solutions in the context of having real-world experience?
So I remember, for background, I was 16 years as a CEO of various energy companies and spent a lot of time in the clean energy space. And a guy who was a mentor to me, he once said, I'm going to give you advice of how to make sure that you minimize the amount of time you spend with lawyers. And I said, all right, that sounds like a good idea. What's the advice? And he said, it's really easy. Don't call them. and I say that in capital markets because he said, if you call a doctor and say, my car isn't working, the doctor says, I'm not a mechanic. If you call a farmer and say, like, my kidney hurts, the farmer's like, I'm not a doctor. If you call a lawyer and you say, I've got a problem, they're like, all right, let's get you a letter prepared. Like, let's get some billable hours out there. And I think there's a tendency for us in Congress to assume that all problems are caused by legislation or fixable by legislation. And, my experience in markets is that I lived through an era where all of a sudden there was this surge of private equity and there were tons of opportunities to access capital and grow a company that were never available to my father, who had built a company out of his own, taken a second mortgage on the home and eventually getting to the point where he could go public. And I just had degrees of freedom he didn't have, not because of a change in public markets, but because a couple Harvard fund managers decided that you could do better than just investing in treasuries. I also had the experience of going through, we raised a bunch of money in 2006 and then in a development company. And so we were long on, we were burning a lot of cash. 2008 financial crisis hits and I get this memo from the managing director of the fund who said, nothing is more valuable than liquidity right now. And I'm sitting there saying, I don't have a business plan that works with this. And so all of a sudden I had to recraft a business that said, I guess we're in the business now of buying existing cash flows, which wasn't what we were doing before, but otherwise I can't keep these people employed. None of that has to do with legislation, but I think we're at a point,
So you had to suspend investment.
Well, we had to basically pivot from a development company to an acquisition company and try to retrain employees, and there was some tension and whatever, it was an entrepreneurial thing. But I say that because, it's very hard to look at the news this week and not get flashbacks in my head of saying how many fund managers are out there right now saying, I have liquidity, which means that I am the king of the world.
Right.
Because I'm going to sit there and figure out who's got 90% leverage, who I'm going to be able to buy at a fire sale. I mean, remember when every 22-year-old Harvard MBA who worked for a private equity firm simultaneously got the idea of convertible preferred equity, right? That's going to go on, and what happens to an economy? And that's not well, it's caused by complete incompetence in the White House, but it's not caused by legislation, right? And so what does the economy do, and what do we do in response to that? Again, do we say I got a legislative fix, or do we say I'm not an entrepreneur? You need to fix that.
Jillian, where does MFA have international offices?
We have an office in London as well as Brussels.
So I mentioned London, Brussels, and there's a lot of the world. I mention it because in this room, we're stacked with ambassadors, economic ministers and counselors from around the world who are interested in this subject here. And one of the reasons they are, and I applaud MFA for having these international outposts, Mario Draghi wrote a report saying Europe's going to go down the drain. It's not competitiveness unless it straightens out its capital markets world. And that we're not able to invest in, solve climate issues or invest in defense until we begin doing this. You could look at some, Asia applications of that. I know we're talking about the U.S. and you're not a member of the European Parliament, but how important is the international dimension of capital markets, considering we have that part of the equation here in our audience today?
So it's interesting. Bill and I were both part of a bipartisan CODEL to all the European capitals with Andy Barr and a number of others.
You went to all of them?
It was literally, it was Basel, Frankfurt, London, Geneva in 4 days or something like that. It was a whistle stop.
Okay.
But everybody was talking about the Draghi report when we were there. And, the consensus in Europe was that the lack of depth in European financial markets required political solutions that were politically impossible. And this just felt like an intractable problem. And it was also, I must say, sort of amusing because this was just before the election. And it was nice to be, a week before that trip being told by every single bank in the United States that Basel was going to kill US banks, and then be told by every bank in Europe, Basel's a gift to US banks. But the flip side is and your audience may have different views on this, but I was talking to a friend who's a managing director at a big asset management firm last week. And she said one of the conclusions in their office is that the result of this tariff policy is going to begin to solve Draghi's problem without any actual political reforms, because they're seeing this rebalancing in some of their portfolios of people saying, I just want to be in a more stable equity market, and I don't know what's going on in U.S. equity. Granted, we're a couple days in, but the United States is the envy of the world's capital markets because of our depth and because of a broad, a general regulatory consistency. Robust investor disclosures on the one hand, robust market access on the other hand, and it's, I think we need to remind ourselves that it takes the world's best home builder can build a house in a year. The world's worst arsonist can burn it down in a day. And we just need to be careful not playing with something that took so long to build.
Well, we're going to end somewhere more uplifting than arsenry. You are vice ranking member on the Financial Services Committee, which is a pretty cool perspective, I would imagine, because you really get to see across the board every subcommittee's priorities and how all of your own members are thinking about their priorities. What do you think will be the big ticket agenda items for the committee this year, and what can you guys do together?
So first, when I found out I was the vice-ranking member at our Democratic FSC retreat, and Maxine said to me, she's like, "Stick around because I got an announcement to make." and then she was like, "You have to give a speech." And I'm like, "All right, I guess I just have to call every day and inquire as to your health." And it is genuinely fun. The one hearing that I sat in on, you do get to be a conductor of trying to figure out what's going on and sort of simultaneously trying to see what French is doing and respond to that. And then, at the same time, Sam Liccardo is texting me saying, "What's the protocol to get in the queue?" And I'm like, so that part's fun. I think in general, and you and I have talked about this before, Jillian, I think every debate on the Financial Services Committee, at least everyone that is like a robust, healthy debate, is between investor protection on the one side and market depth on the other. And there are times in committee where someone will say, all we have to do is one of these and it'll be fine. And that person has immediately branded themselves as an unserious joker. But the interesting debates are always the ones that say, all right, everything we push to this side hurts on this side. Everything we push on this side hurts on that side. What is the balance, and how do we square that out in a way that's responsible? And I think we've gotten it right way more often than we've gotten it wrong on that. But I think that's always the most interesting and useful and constructive debate on committee. And at some level, that's every conversation we have.
One last squeaker, Sean, is Marlin Stutzman kind of played you and Bill Foster a compliment by saying that he welcomes really anything from you much more than the United States Senate. How do you feel about Marlin Stutzman in that equation?
It is a long and old axiom that whatever hostility there is between the two parties, it pales in comparison to the disrespect between the House and the Senate.
Well, on that happy note, I want to thank Congressman Sean Casten. Thank you so much for joining us from Illinois. An entrepreneur. We're going to have to put this way.
All right, a lot going on in the world, a lot going on in global markets. We've talked today about the importance of ensuring our public markets remain strong. What does it take to become public? To have a good experience while you're public, while also continuing to enhance private markets that are really a vital source of capital for so many businesses across the country. I want to thank Deputy Secretary Falkender, Congressman Stutzman, Congressman Foster, and Congressman Casten for helping us to further the discourse today, and we look forward to continuing it with all of you.